is the educational arm of OptionVue Systems. OptionVue has been in business since 1983, specializing in high-end options analytics software. And we rolled out our educational arm about 13 years ago or so, and it's been a great ride ever since. And we started along the lines of having one-on-one mentoring programs, and that's kind of where we cut our teeth, and that's kind of where we've stayed. We have a little bit more to offer in terms of some online courses as well, but and doing the free ones just like this for those that are interested in options. And so what we're going to do today is go over option philosophy and basics, just an introduction to options. Let me click here. Let's see, where are we? There we go. I have to use this other item. Today we'll go into philosophy, just trading philosophy, and then options basics. All right, and so that'll take the better part of an hour or so, and I just want to thank you for joining us. And without further ado, let's get going. The philosophy that we have at Discover Options is based quite a bit on just coming from the area of football. I'm a youth football coach. I kind of tapped into this way long time ago, and it just seems to play out so well. In that, in the world of football, it's very much of a physical contact sport, right? We all know that. And in the world of trading, you have emotional contact going on. It's very violent. Football is a very violent sport physically, and trading can be a very violent activity in terms of your emotions. And so we've discovered a little 4-point plan to get folks from a pretty beginning area up to speed, even trading professionally, and following just a 4-point approach here. And it applies to a football team. Learn, practice, scrimmage, play. We call it the way of the gridiron, and it's had quite a bit of success for us. And let's just go through these one at a time. First, we discussed learning. The way of the gridiron is you first have to learn. Now, on a football team, let's come back up to here. A football team is going to typically start out, doing chalk talks, right? They'll meet in the room, they'll look at the plays, the coach will do a chalk talk and teach the players the plays. Then the football team will go onto the practice field and practice, of course. And then before they go to Monday Night Football, they first have scrimmages. If any of you watched the NFL Network, that's one of my favorite things to watch. NFL Network, you can watch in the preseason teams that are practicing, and then they'll eventually start having scrimmages. And when two teams get together and scrimmage, even before their exhibition games, they'll get together and they'll run 7-on-7s, 9-on-9s, and then finally 11-on-11s, scrimmaging each other in kind of an informal way without even playing a game. All right? And then after that, they're ready to then play the actual football games, Monday Night Football and everything. So in trading, we have a similar approach that we're going to start at the beginning and work up to being able to withstand the emotional contact that true, real trading can bring you. So first, in the world of learning, on the football team, you have chalk talks. In the world of trading, and in the way we do it here is we watch recorded sessions, and then we have homework for all of our sessions before you meet with your mentor. Other people like to read books. Some people get, the books they last a few pages in the books. It gets kind of, crazy a little bit. Other people just devour books, and that's another way to learn. The idea is you have to get the knowledge, the basic knowledge of the material. Okay? That's step one. Learn, and then we practice. All right? A football team, when they go to practice, they're going to do drills. They're going to take what they learn and they're going to break it down and do small drills leading up to running the actual play. They'll practice the plays. And they'll isolate parts of the play and make sure that they're really good at those. In the world of options trading, and the way we teach it here at Discover Options, is we like to practice using OptionVue's BackTrader program. In BackTrader, we've saved option prices every 30 minutes of every trading day going back to January of 2000. Okay, of all assets that trade options, stocks, futures, and indexes. Okay, and so, you know, if something traded options back in 2000, January of 2000, you can go ahead and go, you know, retrieve those prices. And so a lot of times our homework will involve testing various strategies so you can gain the confidence before you actually start scrimmaging, which we'll get to in trading live. Okay, so basically you're paper trading with historical prices, walking through time, experiencing what the market did, and experiencing, for example, what happened in 9/11. You could go back and relive that on watch the option prices as they hop around. We don't talk about the summer of 2002. Of course, we had the crash of 08, and the more recent stuff, we had the flash crash of 11, May of 11. All that stuff, you can walk through it and experience it and get and understand what can really happen. Okay, so practicing could also involve paper trading strategies in real time. Although we like to use BackTrader, you can compress your practicing in a much more shorter amount of time that way. After you practice, we talk about scrimmaging. Football team, after they practice, they're not ready for the game yet. They have to scrimmage against other teams, you know, people that they don't know. And this is a very, very important part of a football team's development. I remember years ago when I had a rookie team, it was a rookie group of peewees, you know, about 8 to 10 years old. And we went and scrimmaged against the more veteran 8 to 10-year-olds. And I'll tell you what, the experience was one that brought it to you right now. You know, we thought we were pretty good. We had practiced. We thought we were executing our plays well. And then we played these veteran travel players. They were on a travel team that traveled outside our city. And within a few plays, my little rookie 8 and 9-year-olds were in tears. They just weren't used to the violence that occurs on a football field. And likewise in trading, sometimes we get into this and we might be good at paper trading, all right? And then when we start putting our real money on the line, what goes on in your head? It was completely unexpected. Hopefully you're not in tears, okay? But that's why, but to keep you from being in tears, we encourage everyone in the process to trade very small lot sizes to gain the experience. And that's what's important, is to keep you away from the tears part of it, okay? We want you to scrimmage. So after you learn, you scrimmage with 1 lot, 2 lots, something like this. That way you also are able to get used to your broker's platform. You know, one time we had a student, and they came to us, and right the first session, they were complaining that something happened when they put an order in. I said, and I got down into it, and what happened was that they went to close out an order. They were trading too large, first of all. They go to close out a position, and instead of closing the position out, they ended up doubling up on it. Oops. And so then, instead of losing a few $1,000s, they look up, you know, a while later, and they're down $7,000 when they were only thinking they would lose a few thousand. So that's another reason to scrimmage small, is to get used to your broker's platform. That part's very important. Finally, you're able to play then. That's when you've gone through the process, you're now able to ramp it up. You begin to increase your position size after you scrimmage enough to show consistent gains. And so this is when you ramp it up. And at Discover Options, we have money management models that will help you ascertain the correct contract size that you could ramp up to. All right, and that's part of all of our mentoring series. We end up with money management, where we help you develop a trading plan that has specific algorithms to get you to the correct contract size. Okay, so that's the way of the gridiron. It's very important to us, and something you should know is that part of the way of the gridiron is that you have a plan, a trading plan that tells you what you're going to do when the market does this or the market does that. And so just like in a football team, you would have a playbook. So in options trading, we have a playbook. There's neutral option selling strategies on the indexes, stocks, or futures, condors, butterflies, and calendars. Also, for directional premium selling or buying strategies on stocks, futures, or indexes, you could do long calls and puts, debit and credit spreads, directional butterflies, and calendars. And our series, our equities series, will teach you all of these in a 14 mentoring session series that you could look at on our Discover Options website and get information on. All right, here's the thing. When you have a game plan, it just helps you to kind of know what you're going to do, and you aren't going to fret so much with the game plan, and you're not just flying by the seat of your pants. So I like to show this. I used to be a single wing youth football coach. We would snap it to the tailback here, and away he would go. Let me switch colors. Just real quick for those of you into the football. What we would do is, if you have a plan and you have this play where you're going to take the blocking back and kick out the defensive end, you're going to pull this lineman around and seal off a linebacker. He's actually one of the tailbacks, he's actually the quarterback. He comes up and seals a linebacker here. Or no, he actually seals the guy out. He's actually sealing a linebacker. What you have then is this wonderful hole where you've created a tunnel. We double team the tackle here. We've created a nice little tunnel for our tailback to run through. Now here's the planning part. We run this and run this and run this until the defense begins to start sending guys over here and they start setting up guys out here. When they do that, then what do you think we do? We come back and do a reverse and go the other way. Just like that. So we have a game plan going into a football game. We have complementary plays, and likewise with any of these other strategies, you should have a series of corresponding complementary moves that you're going to do when the market does this or the market does that. And that we consider that to be a very important part of the way of the gridiron, having a trading plan. Having a trading plan involves establishing your beliefs about the market, and we challenge all our students to do that, whether it's technical analysis, fundamental, watching the news. We want you to have a conviction about the market. If you are our own in terms of volatility and maybe some technical things, we have 3 different mentors that you rotate through when you take our course. And all of them have slightly different market views. But we want you to come in for a landing on your own, because it will be you that is pressing that send button on your orders. It's not us, it's you. So you have to have a firm conviction about what moves the market and why and how you're going to exploit the edge that you have. What is your edge? You have to understand that. Okay? Having a trading plan means knowing the strategies and what are your favorite plays and what you're going to do when the market moves a certain way. And you have to also determine your appropriate vehicle, indexes, stocks, futures, etc., and the position sizing. So that's all part of the way of the gridiron. All right, let me get a sip of water here and let's move on to option basics. 1 second. We're moving along pretty good here. All right, option basics. I want to explore options history, just a real brief history lesson. I'll give you an example before we lead straight into options, an example using real estate to help us conceptualize what options are. And then finally, we'll get into understanding inputs, what they allow you to do, and intrinsic and extrinsic value of those. Okie dokie, let's get going. Options history. In recorded history, the first use of options came to us from Thales of Miletus, a Greek man who did 1 year predict that he predicted correctly that there was going to be a bumper crop in olives. So what he did is he took out options on the use of olive presses, so that if there was a bumper crop, he had the presses to squeeze the oil and get it going. All right, and he predicted correctly, and he made a lot of money using options. Now, on the other side, all right, the tulip mania in Holland. If you've been reading about securities trading at all, eventually you'll come across literature that discusses, the various bubbles that can occur and what happens when they pop. And so one of the very first recorded market bubbles occurred in Holland in the early 1600s, and people started trading in tulip bulbs. And there were various types of tulip bulbs, and everyone started jumping on this thing and trading them. They would buy some from over here, then sell them over there, and the prices began to skyrocket. Having a little bit of a shortage, that's what kind of kicked it off. But it got to the point where a single tulip bulb, all right, cost as much as 2 pigs, basically. Can you imagine? 2 pigs. And the prices were just going through the roof. And so then, during that time, there were various parties that began to roll out derivatives of various types. Various derivatives resembling call and put options from the dealers and the growers. And what happened is that the use of these derivatives resulted in a huge crash where when the tulip bulb prices came crashing down, some of the speculators in these derivatives and options lost, and they couldn't pay, and it was just a disaster. And what happened is after that, that kind of seeped into the Puritan mindset that when they started coming over here to America, there was a huge bias against derivatives of any kind, and really, in a way, that kind of still comes to us today. When you talk to a wealth manager, a money manager, covered calls is about it. They're not going to, getting them to talk about options beyond covered calls is difficult. And so they would just rather divest out of stocks, go into bonds, not even deal with risk management using derivatives. So that kind of negative mind stayed with us all the way up till, in a proactive way, in a more meaningful way. In 1934, after the crash, it became apparent, the crash of 29, it became apparent thereafter that really risk mitigation was very important. And options could play a very important part of mitigating risk. And so in 1934, Congress passed the U.S. Investment Act that created the SEC, and it actually legitimized options. Now, options then had to be, written, customized. There were no standard options for about another 40 years, about 39 more years. In April of '73, finally, Chicago Board of Trade created and rolled out this Chicago Board Options Exchange. And that was the first example of actual standardized options, where they standardized on a set of options that could be then traded back and forth. Each stock option controlled 100 shares. Here's where the strike prices were. Here was the length of days that the stock options would be able to trade. Every month you'd roll out a new set, that kind of thing. What time of the month? When did they expire? And it was all standardized so that there could be more liquidity in these instruments. It was a huge, huge month in April of '73 when that rolled out. It was quite historic in the whole financial community. All right, so that's kind of the history. Since '73, of course, options volume has just gone to where you'll have an asset that trades $1 billion in options. I think the SPX, $1 billion in options per day. Just the liquidity is crazy now in some of these instruments. But you still have stock options, stocks trading well under 10,000 a day even. So, but literally thousands of instruments today trade options. All right, what is an option? Let's put on a different cap here, and now that's the history part. I'm going to show you an example of real estate, and then we're going to go straight to the actual options market itself to examine this. So an example from real estate is one way. If you have a vacant lot, say that there's a lot out there and it can be developed, and that vacant lot is worth, say, $200,000. All right, and let's say that you want to acquire the rights to that lot for maybe 200 days, so that you can then, you'll go to the city and see if they would allow that with the development you want to put on it. And maybe that'll get you some time to get some solid plans in place, get your architect going, and just evaluate it. So you're going to pay $10,000. Let's say you agree with the owner of that land to pay $10,000 for an option to purchase the lot for $200,000 anytime over the next 200 days. And it's important that the contract is transferable. All right, you can take this agreement, transfer it to someone else if you want. Right? Let's say that you put together a package and another developer wants to take it off your hands. That way you don't have to actually do the developing. You just package it for them. Something like that. All right, so you go ahead and do this. You buy it for $10,000. You got 200 days on the clock, and away you go beginning to research this. And so what we would like it to in the world of options, we would liken the $200,000 is the at-the-money strike price. The time premium, we would call it at $10,000. Okay, and the length, the days to expiration, is at 200. All right, time premium, strike price, and length. Now here's the situation. You begin to go down the road of trying to develop this piece of land, and ta-da, after 30 days, it's revealed that a major retail chain is amassing land that includes your lot. They want to obviously build a huge store on it. Maybe it's a Walmart. Maybe it's a Myers. Maybe it's a Woodman's. We have Woodman's up here in Wisconsin, Illinois, mostly in Wisconsin. So some big store wants to come in and build on your lot, and now you estimate that the value is now $300,000. Instead of $200,000, it's $300,000, and you're still sitting on that option, and you still have another 170 days left on the life of that option, right? So now, rather than saying to yourself, I'm obviously not going to develop on this. You could, right? You could go ahead and proceed to develop, but this guy's knocking on your door. They want to buy your land. You say, all right, I'm going to go ahead and sell my option to the chain. Because the chain, he went to the owner, and the owner said, guess what? This guy over here that has 170 days left on an option, you're going to have to go talk to him. They come talk to you, and you say, all right, you decide to sell, and you're going to sell the option to the retail chain who offers you $108,000 for it. Okay? Let's break this down and determine how much profit you made. That's the question. So this is the example that we have for determining intrinsic value and extrinsic. These are important concepts to have in options trading. All right? So let's look at the intrinsic value of that options contract that you have on that piece of real estate. It's worth $300,000. Where's my little pen? All right, it's worth $300,000. Okay, the strike price of that contract, of that options contract, is $200,000. You have the right to buy it for $200,000. That's the strike price of that options contract. $200,000. The land is $300,000 though. So the intrinsic value is $100,000. Now here's the thing, they offered you $108,000. Okay, remember there's 170 days left. They could go off and do something. The price can continue going up. Maybe something else happens. They strike oil, get gold or whatever. There's time value left on that land, on that contract. And so it was for $108,000, and so the extrinsic value of that options contract that's worth $108,000, the extrinsic is $8,000. You're acquiring that for 8,000, you're selling the contract back to him, but the extrinsic is considered time premium, and that's at 8,000. The 100 is intrinsic. 100 plus 8 is the 108 that you're getting. You paid 10,000 for the contract, so your profit is $98,000. This is one of the beauties of call options. You have unlimited upside potential when you purchase a call option, and this is an example of a real estate call option. All right, now let's go over to the world of options now in stocks, stock options. All right, let's say that XYZ stock is trading at $100 per share. All right, now every options contract in the world of stocks controls 100 shares. So let's say that you pay $4 per share, or $400, and you're going to buy a call option to buy, again, 100 shares of that stock. The strike price is $100 per share sometime over the next 100 days. And the option is transferable. Okay? So that's kind of what the scenario is. You're going to pay $4 per share. There's 100 shares per contract. The strike price is at $100. Here's the situation. Guess what? After 30 days, it's revealed that a major retail chain is attempting a takeover of your company, and that takeover price would be at roughly $110 per share, where the stock now begins to immediately trade. And this is what you'll see in the world of takeovers or mergers. Stock prices will immediately gap to somewhere near where the price is that they're talking about. And then it wobbles around there for a while. So it's going from 100, the takeover is at 110, and you go, oh boy, I'm making some good money. Now, you go and look, and your option is trading at $12.50 per share. You're going, wow, $4 going to $12.50. Yeah, you can pretty much know how much profit you're making, but I want to break it down in terms of intrinsic and extrinsic value. We know you made $8.50, $4 to $12.50. Fine. How much of that is intrinsic? How much of that is extrinsic? Let's break that down here, okay? Intrinsic. Okay? It's $110 a share. The contract you purchased, the strike price was $100. Okay? So the difference between the two is called the intrinsic value. In this case, it's $10 a share, or it would be $1,000 because it's 100 shares for that whole contract. Okay, the remaining amount, the $250 of that $12.50 that you're selling it for, is considered time premium, or $250, given that it's 100 shares. Okay. So $12.50 minus 400 is 850 in profit. But that's kind of how we like to break it down. And it's important that you understand intrinsic and extrinsic values, because whether you're buying or selling options or doing spreads, you just have to have a good feel for what the time premium is on any given options position, whatever side you're on, buying or selling. Okay? So when we begin to understand calls and puts, we have that in mind. So let's just start with calls here. Okay? Call options. The call buyer has the right but not the obligation, much like that real estate, when you were a real estate speculator we just talked about, that gives you the right to buy 100 shares of stock from the seller of the option at a certain time. Okay, that's the expiration date set in the future for a certain price, and that's the strike price of that options contract. The seller is obligated to sell the 100 shares of stock should you so decide to exercise it. The buyer pays a fee, and it's called a premium. Okay, what's the next slide? Okay, good. All right. So here's the thing, is that if the price goes up above your strike price, you can then exercise that option, okay? You can exercise that option and purchase the stock. You can exercise the option and acquire the stock at that lower price. Might have been, in the case of this one up here, it was for $100 a share. Went up to $110. You could exercise the option and buy the stock at $100. Boom, there you go. You're sitting on a 100 shares of stock at $100. Look at the other advantage too. 100 shares of stock at $100. Okay, how much money does that require? $10,000, right? $10,000. How much did it cost you to control this stock using a call option? $400. So you acquired control of this stock for $400, where it would have required $10,000 for you to buy it. That's another huge advantage in dealing with call options to control stock, is that you can leverage yourself. Now, it cuts both ways. The price could have gone down, of course. And that's a topic for another presentation. That's a huge advantage here in dealing with call options to control stock that you are bullish on. Let's go to put options now. Let's look at puts. These are a bit different, of course. It's the opposite way. The put buyer gives you the right but not the obligation to sell 100 shares of stock to the seller of the puts at a certain time and a certain price. Certain time, that's the expiration date. The price is the strike price. Now look at this. You can sell puts as well. You can be the writer and you could sell the puts. And the writer then, the seller, we call them the same, it's interchangeable. Writing and selling are considered interchangeable. You have the obligation then to purchase the stock at that price if they exercise the option on you. Okay? Now the buyer's going to pay you a fee, and for puts, it's a pretty good fee in the world of stocks and indexes. All right, now look, put options are a wonderful way to mitigate risk. You can purchase the put, and it gives you the right to sell stock at a certain price. Now, look, if the stock is wobbling around, let me see. If the stock is wobbling around and going up, and you think it might go down, well, if you own 100 shares here and you're making money, what you could do is buy a little put option here before it goes down. And if it goes down too far, you're going to make money on that put option because it'll give you the right to sell at this higher price. Let's say the stock crashes, goes to here, you still have the right to sell it way up here. All right? And that really helps protect these 100 shares that you worked so hard to acquire some profits on. And so put options are a wonderful instrument used by institutions really all over the world to mitigate risk, some short-term risk, long-term risk. They all have various risk models. And so when the market begins going down, these put options can get very expensive. And, all right, and the time value of these put options begins to blow up real fast in the world of put options. Okay, and so if the market does go down and then you exercise those puts to sell your stock at that higher price, guess what? The seller of the puts has to acquire the stock at that price that's higher than where the market is right now. See that? I wish I had a better example, or excuse me, a better drawing, but I think you get the picture. All right, you can sell puts and make money, but if the market goes down past where your put is, you're now obligated to take that stock at that higher price. And so you got to be careful when you're a put seller. And put selling is a wonderful strategy in a bull market, and a lot of people do it. You just got to be careful. And at Discover Options, We have courses that'll show you how to do that. In fact, this today is a free course, but we have a whole nother put section. It's for $199. We'll teach you about put selling, put buying, and give you some scans to use. And you can get a mentoring program, a mentoring session with Frank Fahey to help you understand the world of puts. It's a wonderful little mini course that we offer. All right, let's go into a picture from OptionVue. And this is a picture from, this is a while ago. This is when IBM was trading at 105. And this, but you know, these are timeless examples. And I want to just show you a little bit about the chessboard in OptionVue. And really, you should think of it as a chessboard. You know, chess players get used to looking at a chessboard all the time. Checkers, okay? Any kind of game, any kind of activity, your brain operates within a certain visual framework. And we really encourage you to get used to one mode of looking at options, whether it's your broker's platform, or we prefer you to come over to OptionVue because this was created for an off-the-floor trader. A lot of times the broker platforms are created by previous floor traders, and they were only used to looking at options in the context of long columns of calls on the left, puts on the right, going way up and down the screen in one huge long column. And so Len Yates, our chief programmer and founder of OptionVue, conceptualized back in 1983 an off-the-floor way of conceptualizing options and creating a chessboard that just makes a whole lot of sense. And that's what you're seeing here. Let me show you this real quick. What we have, oops, let me make sure I got this. Boom, boom. All right. We have calls on the top, okay, and puts are on the bottom. Calls on the top, puts on the bottom. Think of it, if the price goes up, you make money in the calls. If the stock goes down, you make money in the puts. So the calls are always above the puts here. Then across the screen, we have the various times that they expire. Okay, in this case, we see July, October, and January options. We have a little number in brackets. This is the days to expiration, how much time is remaining in the life of these options. Then we have the market price showing up here for each one of these. Now, the market price is a combination in OptionVue of the bid and the asking price. Each option is going to have a bid and an ask, just like the stock does. In stocks, it can be a penny wide, nickel wide, just depends on the price of the stock and the liquidity level and the specialists that are trading that. And sometimes the spreads can be quite wide in fast markets. In options, it can vary even more so, far more so in options than in stocks. The spreads between the bid and asks can be quite wide in some options, and so you really need to use limit orders as much as you can to not get destroyed on the wide spreads between bid and ask in options. And so what you'll see in OptionVue is the market price is basically the middle between bid and ask. We call that the market price. And you'll see we have a market price for each of these options. And one concept I want you to get now is what an at-the-money option is, an in-the-money option, and an out-of-the-money option. Maybe you've heard of that. In the money, at the money, and out of the money. So if IBM is trading at 105, okay, let's go to the calls first. We would consider the 105 call to be the at-the-money option. And that's the option that has a little arrow right next to it. That's considered the at-the-money option. Okay? Now, the out-of-the-money options are the call options that have a strike price higher than what the market is currently, where it is at right now. Okay? So the market, the IBM's at 105. If the 110 call, the 115 call, those are considered out of the money. out of the money. Okay? Likewise, if a strike price is lower than the current price of the stock, that would be considered in the money. In the money. Okay? Now, real quick, looking at this, oops, time out. Just looking at this, let me clean this up no, I won't do that. Take a look at this. You can see if you would want an option that you purchase. Let's say you purchased the 110 for 63 cents there. You want that option to go from being an out of the money option to being what? An in the money option. If the market goes up, say to 115, this 110 will eventually become an in the money option. It'll go to eventually be an at the money and then drift to being an in the money. And as it becomes an in the money option, look at how the prices can go up dramatically as it becomes more and more of an in the money option. Do you see that? Okay, and generally you'll see this. The out of the money options have much higher prices than the in the money options. We're going to get to looking and calculating extrinsic and intrinsic here in just a second. But that's what you'll generally see, of course, is the out of the money options have a much lower price than the in the money options here. Now let's go to puts. All right, put options. Kind of got to twist your brain a little bit here. At 105, the 105 put is considered the at the money option. Now, where do you think the out of the money puts would be? You could look at the prices and pretty much figure it out, but it's those that are underneath this 105. Those are considered the out of the monies. And then the in the monies would be those that are higher. Oops, time out. There we go. Higher strike prices. So indeed, let's go to puts. Here we go. When you buy an out of the money put and you think that the market is going to go down, okay, we want the market to go down so that this 95 put, if the market drops to say 90 and this becomes an in the money put, look at how the more in the money puts have higher prices. See that? And so in this case, if we purchase this, we want the market to go down so that this can then become more of an in the money put and have a significantly higher price for that contract. Okay? So that's where the out of the monies are. Then where are the in the money puts? They have the higher price right there. Okay? All right. The other thing I looked at was open interest. You know, let's go back here and let's just review intrinsic and extrinsic value real quick. All right, just to see if we can figure this out from looking at this. All right, so I'm gonna take some time here, erase this. Let's just try and understand some pricing a little bit here. Just take one example, call one example of the puts. How about that? All right. So IBM's at 105. Here's the at the money option at $2.48. That $2.48 is the price of that contract. You can buy that call option for $2.48. Now, does that options contract have any intrinsic value? No. The price of the stock is the same as the strike price of that contract. Let's go down to this 100 call trading at 605. Okay? Now, what is the intrinsic value of that 100 call? Okay, if IBM's at 105, the strike price is at 100, there's $5 of intrinsic value in that call. That call should be trading at least at 105. At least. Anything beyond that is going to be relegated to time premium, because there's 36 days left in the life of that option. So that means that $1.05 is ascribed to time premium, okay? And then the $5 is the intrinsic value. Okay? Got that? All right. Let's go, and so now let's go to puts. All right, let's look at this. This 100 put at 53 cents, IBM's at 105. There's that 100 put. Is that 53 cents? Is any of that intrinsic value? No. No. It's considered an out-of-the-money put, and all out-of-the-money options have no intrinsic value. Their entire value is wrapped up in time premium. Okay? All of these values are time premium only. These are out-of-the-money options. Time premium. The only options with intrinsic value are those that are in the money. Those that are in the money. Okay, so let's take a real fast, and then we'll go on to just cover one last topic. This 110 put trading at 525. What's the intrinsic value and extrinsic? Okay, it's $5 intrinsic, 25 cents for the extrinsic time premium. Got that? All right, so that's covering intrinsic and extrinsic, and it's something that you kind of have to just live with a little bit every day and get used to. That's the best way to do this. And in OptionVue, we can show you the time premium in the matrix. You can customize these matrices to show you the time premium here, just really, really in a slick way. Here's that 525 time premium of 25 cents. See that? And then, of course, all the out of the monies, the time premium is the same amount as the actual option price. See that? Then when you get in the money here, well, now things get different. You have the time premium get smaller and smaller the further and further in the money you go. So there you have it with extrinsic and intrinsic. It's a concept I think it'll be worthwhile. Also, I wanted to show you real quick the notion of open interest. Okay, there's volume for the day, and then there's open interest. So you can go to some of these and see some of these have huge open interest levels. An open interest occurs when, let's say, you go to the market and you purchase a call option and someone sells it to you. You have a position then in that call. Okay, you have a position. Okay, these are the number of contracts that exist that have not had an offsetting position. Okay, when you go to sell that contract, let's say you buy a call, when you go to sell it, that's an offsetting position, that would then reduce this by 1. So the open interest would go down, but the volume for the day would actually go up by 1 or 10 or whatever lot it is you traded. Okay, so these are the number of outstanding contracts that have not had offsetting positions occur. Okay, that's what open interest is. Last thing I wanted to point out before we call it a day or take any questions, folks, for all of our mentoring courses, we offer homework for each of these presentations, and we ask that you do the homework before you meet with your mentor. It's a very important part of learning, and so you'll know that when if you were to sign up for our, whether you signed up for a little mini course with 1 session with Frank, Ken, or Steve, or whether you did a 14-session class for the equities or the 7-session class for the futures, or you get the full boat of 21, each one of those has a recorded session. You have homework to do. Then you meet with your mentor, cover all your questions, and then we will cover any open positions you have in the context of our money management models and compare the two. We cannot give you personalized financial advice. We're not a registered investment advisor, but we can't educate you as to our money management models and observe what you're doing and kind of just make observations about our models and where they sit. All right, and so I wanted to point that out and just take any questions at this point, and thank you for your time, and encourage you, if you've looked at our website, look at those courses, consider ramping it up and getting a mini course if you want on long calls, long puts, or you could go to the puts mini course, consider the futures course if you're a futures trader, or certainly consider ramping it up to the 14 course equities track that we offer as well. All right. Don't see anyone typing. Perfect. All right, folks, thanks so much for your time today. I really appreciate you joining us for this session on an introduction to options. Take care. Have a great rest of the day. Bye-bye.